Thank you so much. Well, thanks everybody for being here today, and let's get started. So what I'm going to talk about here is how to trade market volatility selling options for profits and hedging. So it's a six-step plan that I want to go through with everybody. So it starts out with, let's go through and look at what is step one, is avoiding the number one option trading mistake. Two, the most important option factor. Three, how option pricing works. You need to understand that to then understand, what strategies to look at. Knowing and using the market maker's secret, highest probability option strategies for every market, and option trading defense for extreme market conditions. 1 second here, just getting up the questions too. Okay, so anyway, so the following webinar is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So a little background on myself. I've been actively trading for over 30 years and was previously executive vice president for a company called Trans World Oil, which was one of the largest oil trading companies in the world, and ran their international trading desk for over 10 years out of Bermuda. So a great learning experience for me. And we were really involved and started out heavily involved in oil and then diversified out to the different futures markets and foreign exchange, looking for liquidity. But we were also one of the first groups to trade over-the-counter options on crude oil, and that's where I got my start with options and have been pretty passionate about that ever since. Went on to launch the institutional over-the-counter crude oil options brokerage desk for PVM Oil London, which is the largest privately owned oil brokerage company in the world. And another really great learning experience for me there too, learning a lot more about options and option structures, dealing with institutions and various hedge funds. So just trading, basically here's me back circa 88 in Bermuda, but trading is just a super fantastic, rewarding job because you can basically do it from any place. I was just listening to Serge earlier, and he said I think he was in Switzerland or something. So this day and time, it doesn't matter where you are because we all have pretty much kind of a level playing field as far as computers, technical analysis, and tools that we have at our disposal. But you really want to be educated about what you're trading, and you really need to stay focused about managing your trading risk. Now, the other side of the coin is it can be also a very painful profession at times, which I'm sure probably everybody here can attest to. So when I went out and started trading my own account and other people's money, it really came down to me changing my style of trading. And really kind of one of the big aha trading moments for me was when I started to incorporate more selling option type strategies for both profits and for hedging. So step one is you need to be able to avoid and understand what the option trading, the number one trading mistake is. And option trading has so many more advantages over trading stocks, but you probably also know that it can be a bit more complicated. And for the individual trader, options can also be a little intimidating. Now that's why many investors trade options, by purchasing out of the money options, often short-term options, since they'll cost a lot less than a longer-term option, and it's basically a simple strategy. So, for example, out of the money calls or even puts are especially popular because they're cheap and they seem to follow the old Warren Buffett paradigm, which we've kind of all grown up with, and that's let's buy low, sell high. But is this always the best option strategy? So imagine you're bullish on Facebook and it's trading at $100. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike price of 120 that would cost 15 cents or $15 per option contract. Now remember, one option contract is equivalent to 100 shares, so that would be $15. Now why would you want to do this? Well, when you look at the math, you can do lots of them. So if you were to purchase 100 shares of Facebook at $100, that would cost you $10,000. But you could take that same $10,000 and you could buy 666 contracts of the 120 calls and control over 66,000 shares. Wow. Now imagine then you think, okay, you go through math a little bit more and you think, well, what if Facebook was to hit $121 within 30 days and those 120 calls now are trading at $105 per option contract just prior to expiration. Crunch the numbers on that, you can see you make over $59,000 in 1 month. So at first glance, this kind of leverage is pretty mind-boggling and awesome, but you don't want to let this glitter fool you, because not losing money is just as important as making money, especially when you're in a super volatile period of time like we've been in. Now, one problem with the short-term out-of-the-money calls in general is that you not only have to be right about the direction the stock moves, but you also have to be right about that timing. And that really ratchets up the degree of difficulty. Now, to make a profit, the stock doesn't just need to go past the strike price, but it also has to do it within a defined period of time. And in the case of these 120 calls on Facebook, you need the stock to reach that 120 within 30 days just to make your profit. So it's this dual objective of having to be right on direction plus on timing. This is what really lessens the probability of this option trade being a winning trade when you're just always looking at the buy side. And everything I try to teach my members and clients is that it really comes down to managing your risk and trying to increase your probability of the winning trades. So in this Facebook option trade, you are wanting that stock to move more than 20% in less than a month. And this is kind of like a 2 standard deviation move. And you think about it, how many stocks are really likely to do that? Well, we'll see the occasional stocks that will have these explosive moves, Teslas and the Amazons, but really not many. So in all probability, the stock would not reach that strike price and the options would expire worthless. So based on probabilities, and with options we can theoretically measure probabilities using standard deviation. There's only about a 5% chance for this stock to reach the 120 to 121 level by expiration. So in order to make money on out-of-the-money calls, you either outwit the market or you need to get plain lucky. And we used to always kid around the trading desk. There was an old blues song that said, one of the lines was, if I had no bad luck, I'd have no luck at all. And I think that pretty much kind of tells you how it usually ends up for you. Now, also being close means no cigar. So imagine if Facebook was to go to 110 during the 30 days of your option lifetime. Well, you could pat yourself on the back about being right about the direction the stock moved, but since you're wrong about how far it would go within that specific time frame, you'd still lose your investment. And that's always hard to do, and that's painful. So, based on this trade example, a better goal, in my opinion, for every trader is to select trades based on what provides you the most consistent positive returns and not just that one-time big winner. And consistency is derived from making high probability trades based on reliable data and facts. So where there's a big disadvantage, such as the one you saw in this Facebook buying scenario, you can usually just flip the other side of the coin and see an equal and opposite advantage. So in this case, being a seller of options gives you a huge advantage over being a buyer. So all the pros, they know this and they take advantage of it, and you can too. So as a seller, all the things that you see in this example are going to be the same, but now in your favor instead of against you. So this is why so many people will take advantage and do take advantage of selling options, both for profits and hedging. And remember, options were developed originally, number one, just for hedging. So, a lot of players have gotten away from that, but it's such a great hedging vehicle. Now, by selling options, this is the way you want to do it. If you think about it, you're in essence selling time, and it's really a powerful dynamic. Now, it's a strategy that's yours for the taking. Everybody here, if you understand what to do and how to, the right components that go into it. And I always like to refer to an option. It's kind of like a coupon that you might get at the store, and you must have it redeemed by an expiration date, or else it's no longer valid. And that's how an option is with this expiration date. But how's this done, and what's involved in this process? Well, the most important option factor for this kind of income generation type of trading is really to understand the concept of time. And as you can see in that Facebook example, it's pretty simple to see and understand. Now, time value, though, is used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. And it's one of the key components of pricing. So option income strategies, they're very tied to this component, time value, and the impact that it has on the price of the option. So the time value, we also refer to that as intrinsic value, the intrinsic value of the option. It's basically the premium that you as an investor or trader would pay over the current exercise value, which is known as the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is always going to be greater than zeros, so an option is always going to be worth more than its current exercise value. So as a buyer of options, if you get additional time for your trade, you're willing to pay a little bit extra money for that time. And as a seller of options, by giving that time, you want a little bit extra money because time becomes volatility or uncertainty, and that becomes risk, so you want to price that risk. So let's look at the following chart, and you're going to see how predictable and powerful this option paradigm is, and then I'll ask you a question. So here's a time chart that basically goes out, starting out time decay from 120 to 90 days out. Now, when you go out in your option chain, you'll look out here and you're going to see you can measure time decay by theta, and it's going to be very, very flat at first, and then it's going to start just kind of gradually sloping, and then before you know it, it's really falling off fast. Now, when you get about 30 days out into your weekly options, it's just what I call time decay on steroids, and before you know it, you're at zero. So think about this way: if you've got a major current or tide going out, and you're trying to swim up against that tide, it's pretty hard to do, right? And it's the same situation when you're buying options. As you get closer to option expiration, it makes it more difficult for those options to go against that tide of time decay for you to make money. So you have to understand that part of the element of options in order to be successful. So here's the question. So if you look back at that chart and you were to buy, say, a security, Apple, for example, 120 days out, and Apple was going to go sideways and not go anywhere for those 120 days out, would you have rather, on that kind of non-directional trend, would you have rather have bought those options, or would you have rather sold the options knowing what would happen with time decay? So if you'd rather have sold, just put a number 1 in, or if you want to buy, put 2. Looks like number 1 is the correct answer. So yeah, you'd rather have sold. And really, it's this common natural time value progression. It's this situation for all options. And you could think about it as kind of wandering around in a mountain range blindfolded. You're eventually going to probably fall off the cliff. So step 3 then is, how does option pricing work? So for trading options, you need to understand the components that go into it in order to then understand what strategies to use and how to set them up. So for the value of an option, it's basically the main components will be your time value times implied volatility times the underlying intrinsic extrinsic value. So these are the 3 main components. There are other Greeks that go into it, but this is basically the bulk of it. And once you know these variables and understand how to use them, then you're ready to price that option and know what option premium it should be and how to use it. So here's a good illustration, again, of these major components and how they affect price. So this is a weekly option series, and every Thursday you'll have a new series comes out on a weekly. And when you first have it come out, you've got 100% time in that option as part of the premium. Now we have the pricing of it's the time value times that option's implied volatility times the underlying intrinsic extrinsic, and that gives you your premium, or the option price. Now we're going to keep the underlying at 1 constant because I want to show you the change in time value and implied volatility, how that affects price, and then you know how to manage these components. So on Thursday, you've got 100% time in that option premium. Now times implied volatility, I just put these kind of randomly, so that gives you a price of $300. Now you come in Monday, and your time value part of the option premium is cut in half, so it's down to 50%. Now, even if you increase the implied volatility, it spikes here to 800, so 50 times 800, you're only going to get a $400 premium, barely goes up from 300. So if you had this implied volatility, let's say at 300, then your option premium would actually have gone down and would be only 150. So you can look to see how these components affect the price of the option. In this situation, that time decay really had a major impact even with this spike in implied volatility, and before you know it, you're at zero. So that's the key ingredients to understanding options in general, period. So step 4 is the market maker secret, and this is kind of what they don't want you really to know about because they can really fleece you and take advantage of it. When I say the market makers, these are the market trading models, and actually the brokers that are doing the trades for you. So if you think about it, broad markets will have kind of trends where they might spike up 2 or 3 weeks maybe or days, or they might go down 2 or 3 weeks or days. And then you'll see you'll see the market kind of try to catch its breath, and it'll go sideways in channels. And so it tends to channel more sideways a lot of times, 70–80% of the time. And it's based on this kind of sideways price action that anybody that's been buying out of the money options will tend to lose, and you can particularly look at this theoretically about 70% of the time. Now the market makers, they know these statistics, and therefore they're going to tend to trade from the sell side. And this is the professional money. So if you start thinking like the market makers' professional money, then it's going to help you in your trading in general. And it all comes down to the math of probabilities. So market makers, they use mathematical market probability statistics to price out the movement of an option to its expiration. And by knowing the probability of the underlying security finishing within a certain price range by expiration is key when you're trying to determine what options you want to buy or sell, and then also determining what option strategies that you want to use. So it's these statistics that forecast how likely it is that that option will fall within a certain price, up or down, by the expiration date. And it's this statistical forecast is what's referred to as the implied move of the stock. And it's this implied move that is a theoretical plus or minus 1 standard deviation move of the underlying security by its expiration. So this next chart will kind of clarify that a lot better for you. So if you look at this is a normal distribution curve of data and price in this situation. So based on probability statistics, then you're going to see that selling options and also option spreads, when you use it correctly, is going to provide the highest probability of a trade setup being a winning trade and generating consistent profits. And it also is going to be one of the best ways that you can hedge positions. And it all comes down to the math of probability. So when you look at this normal distribution curve, when you look at an option platform, you're going to be given all this information. You're going to be given the implied move, in this example, plus or minus 4%. You're going to be given days expiration. That's part of the pricing model. You're going to be given the at-the-money price right here. So these are the main things you're going to look at. Now, at the money is where the pricing starts because that's where all the supply and demand is, and then the other out-of-the-money strikes are set, the calls and the puts, and that's what we call option skew. Now, in this example, the expected move that's given to you, based on the mathematical probabilities of the option model for this example is plus or minus 4%. So if it goes down 4%, that would be down to 480. If it goes up 4%, that'd be up to 520. Now, this is based on 10 days to expiration. So what this says is basically this is your expected move, 1 standard deviation, 480 to 520, and that theoretically is at 68.2% probability. So as soon as this trade is put on, whatever trade you put on, you can statistically see that the probability is that it's going to trade probably between 480, 520, 68, 70% of the time. Now, so for example, if you're buying calls out here at 580, and you can see on this curve, distribution curve, that maybe you only have a 2% chance of that actually being at the money or in the money by expiration. So, when you're looking at options 580 out or down here 520, you can see the probability of that being a winning trade really tails off and goes down low. And that's why those options are cheap. So sometimes then you can say, well, I can look at the other side of that, and I say, what if I sold those 580 calls and got a nice juicy premium, and it's only got a 2% chance you can get there, so then I've got a 98% chance that could be a winning trade. So that's how those statistics can help you to decide what to do. And remember, trading is really a business of probabilities, and to be successful, a trader, you need to be focused on controlling your risk, and one really important step is then knowing the winning probabilities of any trade you're looking to take. And there's a really good, simple, and free tool that you can also use to measure probabilities where you don't have to go into your option analytics to do it. And that's what we call the option group, the delta. Now, the delta is a great tool. So it can be used to value the option based on the underlying move, and it also, you can use it to measure the probability of price of the underlying itself. So I use this for kind of a down and dirty, quick way to look at probabilities of price, where price can be. So here's an example. Now, in this example here, you're going to see the option delta 68 to 70. Now, that would also, if you look at that, that also then equates to a kind of an approximate 68 or 70% probability that the underlying security will be in the money or at the money by expiration. So that's another way you can use it, which is a really quick, nice tool to have. Now, if you look at the option delta and it has a plus or minus 16, that's equivalent to this outside area of that one standard deviation move right here, 520 and 480. And that 16 delta also equates to that strike having a 16% theoretical chance of being in the money or at the money by expiration. So here's what it looks like just to back up that. If you look at the option platform, here's on that same example, Google, to show you a one standard deviation implied move on the Thinkorswim option analyzer. So here you're given the price, 582.45. You're given days to expiration here, 22. You're given the expected move here, plus or minus $34 up or down within a 22-day period. So in the option analyzer, you can set what we call price slices. So you can set movements up or down. You can set percentage movements or volatility implied standard deviation. So here I set it to one standard deviation up, one standard deviation down. Now that crunched the numbers, and it gave a price of $622 basically to the upside based on the at the money price that used, and $542 to the downside. Now, to do that every time for an option trade sometimes kind of takes a little bit too much time. So what I like to do is then I can come over just to the strike price here and take a look. See the 620 call? Here's 622 was one standard deviation. Now follow that over, and you see that gives an 18 delta. The delta of that 620 strike is 18. So basically what that tells me is that if the price is trading here at 582 and I look at that delta of 18, that's telling me that it only has an 18% chance to get there, and that's that one standard deviation move. So here's a really quick way for you to kind of use to gauge what's realistic for your trades, even if you don't use options. So using this kind of probability analysis, it provides traders a very useful tool to determine price targets to trade against, and it's great also for setting up your hedges. So again, based on math of probability, you can see that about 68.2% of probability of options bought are going to expire worthless. And based on this, I think it's a really great idea if you also, consider the sell side also as well as the buy side. So I do both, but the sell side is great for certain conditions. A lot of times when implied volatility is high, and it's the best strategy you'll see in a little bit for hedging. So it's this added option strategy for both profits and hedging. It can really make a huge, dramatic, and positive difference in your performance. And it's, again, why the professional money takes advantage of selling options for profits generation and risk management. Step 5 then is selecting the right income strategy or option strategy. And again, the goal as a trader, you should be looking to select trades that provide you, with consistent positive returns if you want to stay with the business, not always that big one-time hit. And one of the best ways to achieve this is by knowing what income option strategies are available and then selecting the one that best suits your trading style, your management trading plan, your risk profile and your capital that you have to trade, because everybody here will be different as far as all that you goes into making your trading decisions. So the basic income strategies that are out there available are the covered calls, you got the calendar spreads, diagonal spreads, long iron condors, and credit spreads. So they're all good strategies, but some are better than others for certain market conditions. And for me, my favorite of all those strategies is the credit spread for 4 good reasons. 1, it can work regardless of market direction. 2, it can almost work even if you're wrong, which is always nice if that can happen. And 3, the probability of profit, theoretically, as soon as you put the trade on at a 1 standard deviation move or point, is 68% probability, even without adding technical analysis, which then increases your profit probability even more. So it's also perfect then for hedging, which you'll see. When you think about that concept of time, this is what really makes this the ideal type of strategy for your hedging. So there are 3 different main types of credit spreads. You've got the bear call credit spread, that's a bearish strategy. Bull put credit spread, bullish. Long iron condor, which is neutral. Now, the bear call credit spread is best used if you think the market's going to go down. And it's a capped risk type strategy where you're selling one call with a lower strike while simultaneously buying a call with a higher strike and in the same month. Now, you can just sell calls naked or puts naked and make a lot of money, but you do take on a lot more risk by doing that. And this is a way that you can cap that risk. So here's an example of the bear call credit spread. So, and this is on the S&P 500 SPX, which is a great one to do these strategies on. So here, it's trading down here about 1988. Now, you're making your trading decision thinking directionally that the market's going to probably move lower to sideways at best. So you decide to sell a bear call credit spread. It's a bearish strategy. But it doesn't even have to go down. It can just go sideways and you'll make money because of the time decay. So here you're selling 2045 calls short and above it buying the 2050. Now that's a $5 wide spread or $500 wide. Now this credit spread you received when you sold it, $100 credit, that goes straight to your bank account. The difference in the $500 wide spread is your risk at risk, $400. That's your margin that you have to put up. And if you do no defensive strategy to defend that strike, the worst case scenario would be that you'd lose $400. Now, as long as it trades and stays below that short strike, you make that 100. That's a 25% return on your margin at risk. That's all you have to put up. Now, this trade was like a 15-day trade, but these are, you can do these on weekly for certain stocks. So that's what it looks like for a bear call credit spread. Now, the bull put credit spread is going to be best used when you think, what? The market's going up. It's a bullish strategy. And you're going to sell one put while simultaneously buying another put with a lower strike. Now, this is so to cap your risk. Now, if you wanted to, and if you've got a margin portfolio account, you could just sell puts naked, collect that premium, but you've got a lot more risk if you're wrong. So this is how you cap that risk. And here's an example of your bull put credit spread. So here's a win. It's trading at $207 right here. Now, instead of, you think it's going to go up, but instead of buying the stock or buying the options calls, you're a little bit more conservative in the trading strategy. So you sell out of the money, 1 standard deviation, bull put credit spread. So here's your short leg at the 187 strike. Here's your long leg below at 182. Now, that was below the prior low and also about 9% below where Win was trading. You received $130 credit, goes straight to your bank account. The difference between the credit received and the width of the spread leaves you the balance of your capital at risk, margin put up 370. Now, as long as it closes above that put spread, you keep the 130, and your capital at risk, 370. That's a 35% return on your capital at risk or margin. It's a nice return and a nice, less stressful trade than if you're trying to buy at the money or stocks or whatever. Now, the third strategy is what we know as the long iron condor, known for being kind of a non-directional, neutral low-risk trading strategy. And all it is really is combining that bull put credit spread with the bear call credit spread. So you have those two credit spreads together where you're basically sandwiching, strangling the price between it. So you basically want a sideways price action, here in your two credit spreads, your call vertical credit spread there and put there. As long as it expires below, in between, you keep the max credit. Now this is the key here. So you'll see the big difference when you compare risk to reward. And this is going to show you the risk reward for two long directional option strategies. Strategy one is the typical, hey, let's go long the market. We're going to buy calls. We think the market's going to go up. Strategy two, though, you're still bullish, but you're going to be a little bit more cautious with the market, conservative, and you're going to sell an out-of-the-money bull put credit spread. So here's strategy one, and we're going to say John, he's super bullish on win, so he's going to go out and John's going to buy the at-the-money June calls, 207 calls, and they're going for $11.40. So that's $1,140 for one option contract. Now the great thing is he's got unlimited upside potential. Now he's also capped at his premium paid, but that's quite a bit of money maybe for one option contract for a lot of account sizes. Now that's John. Now Susan, though, is going to be still bullish, but she's going to be a little bit more conservative on her trade, and so she's going to be putting on a bull put credit spread bullish strategy, but she's going to sell out of the money the 187 put by the 182. Now when this trade was put on, win was actually, the low was 189, and she was selling this trade, this bull put credit spread, 9.5% below where it was trading. Now let's go see what happens when the market doesn't go the way you want it to go. So trade one, John, he bought the calls outright. And John opens up his P&L on the 8th of May, and he notices that, all of a sudden, man, win is down to $196. It's crashed down here, which we have seen that happen quite a bit. He looks at his P&L. He's down $583 for one contract. That's smarts, So, finally the market bounces back, and on the 21st of May, it's bounced back up to 205. But, it's $2 below where he put it on, but he opens up his P&L and he's still down $518. So not much of an improvement there at all. Now Susan, on the other hand, she's also bullish, but she did the bull put credit spread, selling that spread way below where win was trading right here, one standard deviation. She was able to get $130 credit. So if she's right and it closes above that short strike, she'll make a 35% return. Now, what happens if she's wrong and it goes down? So on the 8th of May, it's at 196, right down here. Susan looks at her P&L, and she's only down $38.50. Well, not too bad. I mean, John is just still really hosed, down $583. Now, on the 21st of May, Susan looks again. It's finally popped back up here to 205. So she opens up her account. She looks at it. And she can see that she's actually making money. She's up $78.50, and John's still down $518. So you can see there's a big difference. These are two bullish strategies, but they're two different risk profiles or parameters on that. So step six is to show you a couple more examples of this. The beauty of the selling options and option credit spreads. So I also call it the most forgiving trading strategy ever, the credit spread. Now here's an example on Amazon. This was an out of the money, a bull put credit spread. So this is a bullish trading strategy, and this was done last week. So this was a setup using it's a directional trade. My trading model, I use a lot of momentum indicators that I've developed, moving averages, Fibonacci, a lot of different things. But you can see that Amazon got crushed to the downside. Now, it started to stabilize. I was looking for a momentum trade to the upside. Momentum started to shift back up using multiple time frames, the daily, and here is the 7-8 minute. We got a nice trend line, was starting to break here. Momentum was up. So wanted to go long Amazon, but still was very cautious to the market. So instead of just going, major long stock or calls or whatever and having to pay a whole lot of money with a lot of potential risk, the trade setup was to do an out-of-the-money bull put credit spread. Now, the other big part of this was that at the time, the implied volatility was over 70%. So what does that do? Implied volatility is one of the price components, so that really jacked up the premiums. So it made it nice, really fat, juicy premiums to sell and take advantage of. So here was the trade set up. When you look at where it was, Amazon was trading here at 495. You can see implied volatility was fairly high. So sold down here, the 470 down here, bought the 465 bull put credit spread. This was about 1 standard deviation out of the money from where it was trading on a weekly option. So it was defined risk trade. And now as soon as that trade was put on, without any technical analysis, that gave me about a 68% chance to win on this trade. So here's what it looked like. When you go in and look at the analysis, the max potential profit received $100 credit, $500 widespread. So that would put the max capital at risk 400. Going into it based on out of the money, selling it was 68% theoretical probability, so 1 standard deviation. Now, the potential return was 100 profit, and your capital at risk, that's 25% return. But I like to take these off. If I get 70-80% of it, I'll go ahead and take it off. So went ahead and took it off. It made $75, so reduced my risk by just getting out. That's still an 18.75% return, and that took 2 days with a probability of 68% without any technical analysis, and based on my indicators, that increased it even more. So you can see here, based on that trade, I mean, if you did, 5 contracts here, you received 100 credit, you took it off at $75, that's over $375 in a 1-day period, and that's a nice little 18.75% return with a high probability winning trade going into it. Now the other way I like to do this is to show you how you can use this to defend a core position. So this was long Tesla on a call debit spread, started going down against me, so I hedged it by selling a credit spread against it. So here's the trade setup. So I'm getting short on time. So here Tesla's moving down hard. Had a trend line break here. Wanted to take a shot at to the upside, but I had my plan. If it didn't get to the $205 the next day and it started to roll over, I was going to immediately hedge it by selling a bear call credit spread against it. So it started to roll over. My momentum shifted. So I immediately the next day sold a bear call credit spread. So the original trade was long a debit spread. Cost me $225. That was the 197.202.5. Okay, $225. Now, here's what that looked like. $225 debit, so that's the max I could lose. But I didn't want to lose $225. The market started to roll over, so I immediately sold a bear call credit spread the next day, shorting the 202.5, 207, brought in $152 credit. So what does that do? That reduces my risk exposure to the downside by taking in that credit. So I immediately, by doing that, that reduced my risk just to $73, 152 from 225. So now if I did nothing else, the max I could lose is 73. But I went ahead and got out of the debit spread side, took a loss of $52, left the credit spread side 152, market continued down. Long and short, this trade ended up making $100. So original trade was $225. Credit received 152, reduced my trade to a loss of 73. Got out of the long debit spread, lost 52. Kept short the credit spread. Expires worthless, make $100 versus losing $225. So this is a real kind of a great way to use this for any kind of core position. And, unfortunately, I kind of had to go through a little bit more hurriedly than I'd like to, but that's basically the concept. And, this is stuff that you should look at more so incorporated into your trading. So I've got some questions here. Here's a few really nice comments, and then I'll take some questions and teach you or tell you more things that you can do in order to, take advantage of this kind of trading. So let me show you this. It's always so rewarding to get good feedback from your customers and clients. So that I wanted to share that with you. So let's look at what you can do now. I've got a really great course package that I've put together for you that you can use for income, profits, and hedging. Now, this is a course that I actually was just completing today before I got in. So now it's going to be on demand. This is a brand new course that I just have done, and it's a 5-hour on-demand course. I'm actually finishing up Monday night, but it's a 5-hour plus course on demand that you'll get. Now, it's 100% on selling options for profits and hedging, like I was showing you here, but it's much obviously more detailed. So in this course package, here's the link. It's, let me put it in here. It's powercycletrading.com/best. And go ahead and, I've got 30 slots, but since it's a multi-speaker thing, I'll go ahead and leave this open for the rest of the day. So just use powercycletrading.com/best. I've got 30 spots, but if I go over a little bit today, I'll go ahead and keep that open for you. So go ahead and give it in case I do shut it down. But what you're going to get in this course, let me show you everything that you'll get with this. So it's $97 plus money back guarantee, but you're going to get my course that I just am completing. This is a selling options for profits and hedging. It's on demand, 5-hour plus. It's broken down in modules of 30 minutes on trading using credit spreads for both profiting and hedging. So all 30-minute modules. Now, once I put it up on my site, it'll be at least $297. Now, you're also going to get a live follow-up support Q&A. So we'll do a live follow-up coaching session on this. You'll always have questions regarding what you're learning, and this will probably be in about 2 weeks to give yourself time to go through the course. And then I'm also going to throw out here today for anybody that signs up a trial membership to my trading club. I've got a virtual trading room, offer a lot of great things there. And this is, if you decide to stay in, it's $97 for each month. And you can cancel anytime. Plus, you're going to get my 13 option strategy diagram. All that just for $97. If it doesn't work for you, send us an email. We'll refund your money. And here's just kind of basically what we've covered in this course here. The option Greeks that impact selling options. How to use those credit spreads to create a low-risk, high-probability trades. You can get into these trades for as little as $50. Here's a big part of it, how and when to use the credit spreads for hedging any kind of core position that you might have on. You might have on long stocks, you might have on calls, call debit spreads. I'm going to teach you in this course how to hedge that quickly to take the stress and let you make right decisions. And then a big part that I like to use, how to credit spreads for stocks and index options such as SPX, NDX. How and when to use the deep in the money credit spread, which reverses that risk reward to positive. So you can learn in this course how to steadily and consistently grow. You can take a small account and consistently, with lowered risk, turn it into a bigger account using credit spreads. And here's another big part of it, the adjustments. How do you defend a credit spread that goes wrong? So I'm going to teach in this course also 6 defenses just for the credit spread. And then when to use the iron condor. It's not something I use a lot, and I teach in the course why, and then I teach you when to use it. Position sizing is a great way to diversify your risk on the positions, so how to do that. And how to take that 68-70% probability trade that you go into, turn it into a higher probability trade. Step-by-step guide for executing the spreads, some technical analysis that will help you. Best market times. When do you sell? 5 days out, 10, 30 days out, and when do you take them off? And then when do you place the trade? I'll show you how to do it end of the day so you don't have to stare at your screen all day. So it's a really great course, fresh, brand new, based on current market conditions. Trading club, here's what you get. Virtual trading room open each day. I do daily market video updates every day on what I'm doing in the market. We do an hour-and-a-half weekly Q&A every week. I have an educational vault. You get credits for every month you're a member and discounts on all my trading models, indicators, and courses. So money back guarantee, great course. Hopefully you'll take advantage of it today and join my trading group membership. So hopefully this is stuff that you're going to be interested in. I think it can really help anybody's trading. If you're a new beginner trader or advanced trader, this is stuff that you really need to know. I can't really stress how important it is to be able to better manage your trades. So again, thank you very much for having me here today. Let me see if there's any questions I can get into. Yeah, the trading club. When you come in my virtual trading room, I tell you whatever trades I'm looking at doing. I show you how to structure the trades. And so I show you in the trading room those trades. So if you can come in the morning, the first hour, hour and a half, last hour of the day, that's usually when I'm doing those trade setups. And then we also do, day trades as well.